New fears about the economy and the banking industry, with the possibility that even more institutions could fail after the collapse of Silicon Valley Bank.
Well, this morning, regulators are stepping in to stabilize Credit Suisse as the European banking giant endures its own troubles, separate and apart from what we saw in the U.S. And here's a look at stock futures after that wild ride on Wall Street yesterday. At one point, the Dow was down more than 700 points.
Okay, so one of the main questions right now, is this the beginning of what happened in 2008, the financial crisis that took years to recover from? Well, let's ease your minds right now out of the gate. Our experts say no. But there is a lot you do need to know about your money and what happens next. NBC's business reporter Brian Cheung gets us started. Hi, Brian. Good morning.
Good morning. The dramatic failures of Silicon Valley Bank and Signature Bank over the weekend triggered a swift government response in an effort to stop the bleeding and prevent widespread panic. But now, two additional banks, one at home and one abroad, appear to be under pressure. All eyes are on Wall Street this morning after a roller coaster day of trading sent stocks sliding, with nervous investors worrying about the health of the banking system.
We have yet another day of banking concerns dragging down the market.
The focus now, Zurich-based Credit Suisse, one of the largest banks in the world. Customers pulling their money out of the firm led the Swiss National Bank to pledge help if necessary. Overnight, Credit Suisse accepted that help, saying it would borrow up to $54 billion in an effort to reassure investors. Here in the U.S., the focus is on California-based First Republic. Two credit ratings agencies downgraded the bank, with S&P ratings citing elevated risks of customers pulling their funds. The company declined to comment on the downgrades.
If more banks domestically were to fail, what would that do to the economy?
Well, if we saw widespread failure, that would significantly weaken the lending growth, the growth to businesses and households. That would undermine the economy, and we would go into recession.
Those concerns causing some First Republic customers to visit their branches shortly after Silicon Valley and Signature Banks went under.
I got scared and came down to talk to them and was going to take out the little bit of money that I had.
I feel confident enough that I'm not taking money out. I'm putting money in.
Experts say those worried about their savings accounts should remember that insured banks and credit unions protect up to $250,000 per depositor. For the people that are looking at the news and going, do I need to pull money out of my bank? What do you say?
Generally, I say no. So when we're thinking about having money in a bank, when it comes to banks, there's FDIC insurance. So really that comes into play with loss of deposits, checking, savings account.
This morning, Treasury Secretary Janet Yellen is expected to face some grilling over the banking system on Capitol Hill. According to prepared remarks, Yellen will reassure that taxpayer money is not being used or put at risk in the fallout, and that Americans can feel confident their deposits will be there when they need them. Savannah.
All right, Brian Cheung leading us off. Thank you. Joining us with more perspective on what's happening in the banking industry, what it means for your money. We have CNBC anchor David Faber with us. Good morning.
Good morning.
We need someone who speaks fluent CNBC this morning. But let's just get one thing out of the way.
Sure.
This is not 2008.
It is not.
This is not a financial collapse. This is not something that threatens the entire financial system of our country.
Not at all. I don't want to not take it seriously because it should be, but it is in no way equal to what we saw in 2008, where we had massive financial institutions that were deeply embedded in the U.S. financial system, the world financial system, about to collapse, and therefore we had to worry about the overall system. This is not that.
But that said, there is a concern, and in a strange way, fear is the thing to fear right now. If people start panicking, if they think that their banks are somehow imperiled and start pulling their money out, that creates the crisis. Like, you have this situation where it could be a self-fulfilling prophecy.
That's, in fact, what we've seen to a large extent. Yeah, confidence is the key in the financial system. It was the key in 2008 as well. It went away very quickly. Here, if depositors don't feel comfortable in some way, if they're not confident their money is safe, they may choose to pull it. As a guest said during that piece, if you have $250,000 or less in a bank, you're completely safe. You have an explicit guarantee from the FDIC for the insurance there. And over the weekend on Sunday, the Federal Reserve, the FDIC, the Treasury also made an implicit guarantee that even if you have uninsured deposits above $250,000, you should be fine. But that doesn't mean that people aren't still concerned. And there are certain banks where there are particular characteristics, Savannah, that have led people to say, you know what, I'd rather be safer moving my money to one of the biggest banks where I know it's going to be fine.
And just real quickly, this Credit Suisse, which we've seen, it's a Swiss bank, and it sounds like Swiss regulators are stepping in to shore it up. it had a whole separate set of problems. So it's in a way a function of bad timing as well.
It is bad timing. It's not completely disconnected from this because, again, it goes to confidence. It goes to concern that is raised when you have what's going on here in the United States with Silicon Valley Bank and Signature Bank. That said, Credit Suisse has had a series of mismanagement and has suffered from that. And so there has been a loss of confidence over a long period of time. The Swiss have come in to try to make sure that that bank is safe because it's an important one and a very large, important European bank.
It's a biggie. Real quickly, the Fed obviously is going to meet next week. The question, will it raise interest rates again? We've got inflation coming down, and now we have this banking situation. What do people think is going to happen?
Well, there had been an expectation the Fed would continue on its aggressive rate rise, so to speak, maybe as much as 0.5%. That has changed since we've had this, what call it a mini financial crisis. And so the question becomes, do we get a 0.25% increase or none because of the concern? Remember, the Fed is not just worried about inflation. Financial stability, which is what we're talking about here, is also its number one concern typically. So there's the possibility, and we debate this all the time on CNBC, that we will get no rise in interest rates. And in fact, rates have fallen in the bond market over the last week rather dramatically.
All right, lots to watch. Thank you very much. Good to have you here. Appreciate it.
Hey, thanks for watching. Don't miss the Today Show every weekday at 11 a.m. Eastern, 8 Pacific on our streaming channel, Today All Day. To watch, head to today.com/allday or click the link right here.